Welcome to the SPARX Japan Focus All Cap Strategy commentary for the second quarter of 2025. I'm here to share my perspective on the portfolio strategy, key holdings, and the broader Japanese equity market, weaving together the themes of portfolio differentiation, margin of safety, and my focus on long-term growth opportunities. This quarter, Japan's markets face significant macroeconomic shifts and political developments, including the July upper house election. We remain a fundamental bottom-up stock picker, but are always mindful of the environment in which we find ourselves. At the core of my strategy is portfolio differentiation. As I've emphasized before, to outperform the market, our portfolio must diverge from the index and other active managers. This means taking bold, high-conviction positions in undervalued companies with strong fundamentals, often when market sentiment is skeptical or indifferent. My large-cap focus leads us to hold substantial positions in widely owned stocks like Seven & i Holdings and SPARX Corporation, where I see significant upside due to their undervaluation and robust margins of safety. However, differentiation comes with challenges. Holding contrarian positions can feel uncomfortable, but as I have noted, being comfortable in the uncomfortable is often a recipe for future outperformance. The margin of safety remains my bedrock. Inspired by Benjamin Graham, I seek stocks trading well below their intrinsic value, providing a buffer against market volatility or misjudgments. For instance, Seven & i Holdings, a key holding of the strategy, trades at a forward PE multiple significantly below the market average, with a strong free cash flow and a massive 600 billion yen share buyback program planned. The market consensus for the valuation is generally based on the Japanese accounting standards, which underestimates the cash-based earnings of the company. By looking at the fundamental data in the comparison to IFRS standards, it would adjust the valuation lower. And this is an example of the market inefficiencies that are misunderstood by many market participants, which allows us to maintain our edge. Its convenience store business, underpinned by global expansion potential, offers both growth and stability. Even after Alimentation Couche-Tard's withdrawn acquisition bid in July, the stock's valuation and takeover appeal provide a solid floor. Similarly, SPARX Corporation's shift toward an asset management model with a price-to-book below 1 times and a 6% plus capital return yield exemplifies our focus on safety and upside potential. My new investments in Japanese home builders, Sekisui House, Sumitomo Forestry, and Daiwa House reflect my optimism about their U.S. market expansion. The U.S. single-family housing market, with a structural shortage of 3 to 4 million homes, offers a compelling growth runway. These companies, leveraging their manufacturing excellence and high-quality construction, are gaining traction, with Sekisui House ranking 5th in U.S. home sales in 2024. Their valuations at 8 to 10 times forward earnings and 3 to 5% dividend yields provide a margin of safety, even amidst short-term uncertainties like rising mortgage rates. Recruit Holdings, another core position, demonstrates my focus on companies with dynamic competitive advantages. Despite a softening U.S. labor market, Recruit's record earnings and AI-driven innovations like Indeed Career Scout strengthen its market leadership. Its free cash flow often exceeds net income by a wide margin, even after adjusting for share-based compensations, though I remain cautious about aggressive accumulation at current valuations, awaiting potential buying opportunities. Turning to the broader market, Japan's equity landscape was shaped by significant macroeconomic and political events this quarter. The July upper house election saw the Liberal Democratic Party retain power, but with a reduced majority, signaling potential policy shifts. Investors are closely watching Prime Minister Ishiba's agenda, particularly on fiscal stimulus and corporate governance reforms, which have bolstered Japanese equities in recent years. Despite this, Japan's market remains relatively inefficient compared to the US, offering opportunities for active managers like us to capitalize on mispriced assets. Globally, economic uncertainty tied to US policies under President Trump has weighed on sentiment, impacting sectors like HR technology, as seen with Recruit. Yet, Japan's export-driven economy should benefit from a benign currency environment and resilient US economy, supporting companies like Sony Group and Hitachi, long-term holdings since 2019 and 2021 respectively. I maintain my high conviction in Japanese insurers due to their global expansion in specialty insurance. I also sharply increased our position in SoftBank Group during the quarter, a key beneficiary of the AI revolution. In summary, my strategy remains committed to a differentiated portfolio with a meaningful exposure to undervalued large-cap global Japanese companies relative to their growth, anchored by a disciplined focus on margin of safety and long-term growth. Whether it's Seven & I's global ambitions, ORIX's valuation shift, or the home builder's US expansion, I am positioning for outperformance by embracing calculated risks. The Japanese market's inefficiencies, coupled with macro tailwinds like corporate governance reforms, reinforce our conviction. Thank you for your trust in the SPARX Japan Equity Focus All-Cap strategy. I will continue to navigate these opportunities with discipline and foresight.